Welcome to the next Allsop podcast. My name is Andrew Hoban and I work in the Commercial Valuation Team at Allsop. Delighted to introduce you to Greg Manson, Director of Finance at OakNorth Bank. For those of you who haven't heard of OakNorth, it's a British bank that provide loans, business and personal savings accounts. I think the bank was founded in 2015, is that right, Greg?
Certainly was.
Known originally as the Entrepreneurs Bank.
And still known as a bank for entrepreneurs by entrepreneurs.
Brilliant. And for those of you who haven't heard of Greg, he's both a banker and a chartered surveyor. I've known Greg for a long time, and 2 years ago, Greg set out on the journey to become a member of the Royal Institution of Chartered Surveyors. I remember being part of that process with you and sitting in on the...
Not only a part of that process, you were instrumental in helping me with my APC, so thank you once again.
You're very welcome. Well, thank you for joining us today. Call it payment then for all those sessions.
Do you charge interest?
No interest. I think that's your job.
That's my job.
But one of the reasons for the podcast today was really to educate our listeners and demystify the property lending process, what steps you go through, how it's all structured. So I'm looking forward to hearing what you've got to say and just enlightening us on the process. First question to you, what happens at the very start? So you've got a client that comes to you, they've got a mixture of assets. Let's say it's a mixed-use portfolio. You've got a bit of office, retail, a bit of leisure, a little bit of resi in there. What happens? What's the first step?
We get approached often on the phone or by email from whether it be directly from the borrower or some kind of debt facilitator, debt agent, broker. And the first question I'll always ask is what the asset base is and who the borrower is. People sometimes come up and say, well, I've got a portfolio worth 100 million, can you do 60%? And when you get such limited information in, you get very poor analysis out. I generally reserve judgment on leverage and pricing until I've got a full picture. What do I mean by a full picture? I want details on all the assets, what the weighting is towards office, leisure, residential, what the cash flow is looking like, the blended WALT, and most importantly, who the borrower is.
Okay.
Where's the capital coming from? Have they got experience in managing these assets? Why are they buying these assets? How are they buying these assets? Is it open market or do they want leverage against an inherited portfolio? It makes a difference in terms of their capabilities and their liquidity. And of course, what the consideration is, right? If they're buying it in the open market, as you would be able to determine, you're probably somewhat closer to the real value than you are if you're picking it up elsewhere. Yeah,
we come across that all the time where investors are buying things off market, and there's a story behind that, and it takes time to understand what that business plan might be. So I guess as the Entrepreneurs Bank, you want to understand their business plan.
Yep.
Their proposals are as important as the assets themselves.
Absolutely. And I think once you get comfortable with the real estate rather than anything else and the borrower strength, then it's down to cash flow and strategy. How are we going to get repaid? What is the resilience of the income looking like? Why are you, the borrower, comfortable with this as an acquisition and the long-term gains to be made from this piece of real estate? Because let's be clear, no one buys property to lose money. They either want to hold it for yield or they want the capital growth, or ideally a combination of both. Sometimes there is a value add strategy, whether that be through active asset management, commercial property leases, or planning consents, or cutting up units into smaller lots, generating higher rent, stabilising and selling, whatever it might be. Sometimes it's as simple as buying at 12%, selling at 9%. It can be that simple, and where there's evidence to support, that's often quite a good strategy, pure trading. But you need to be watertight in your analysis, especially for things like shopping centres, because there seems to be a lot of that at the moment. So making sure that the footfall's right, making sure that the occupancy's right, making sure that the void costs aren't punitive, so that the resilience of the net operating income can see through the strategy.
Timing is so key, isn't it?
Timing is everything.
It's so key.
And there's so much luck that goes into it as well. Sometimes, anecdotally, I'm speaking to my borrowers and they're like, yeah, I just timed it right. Yeah. Or I just got lucky. You buy something and all of a sudden you get an email from the head of property at Primark saying that they want to take 50,000 square foot and you can't accommodate for that. Or is it a sixth sense?
Yeah. I think one has to admire an investor client's honesty when they say they just
totally.
bought well at the right time.
And sold well, more importantly.
Yes. And I think, it's, especially when you're looking at, and I know we dealt with stuff together where it's just been a single income strip. It's been secured against a very strong covenant. And of course, the value of that is linked to the cost of money. And it's sort of
Which is volatile.
Very much so.
You've got 10, 12 years of relative low interest rate environment, cheaper equity, cheaper debt, more transaction volume. When both of those go up quite drastically over a relatively short period of time, slams the brakes on the market transactions, which means values plummet. Yeah. Or maybe that's the wrong turn of phrase. I would say purchase prices reduce, no transactions take place, and then values are uncertain.
They are, yeah. It becomes more challenging for us to sort of work out where we are in a moment in time. You mentioned just now about, obviously, your client, the borrower, they're a key part to it. One thing I was going to ask, and we see this a lot where they're not borrowing in a personal name, me as Andrew Hoban, you as Greg Manson, but they'll set up a company name. Why is it that they'll be structured that way? Is it SPV? Is it special purpose
listen,
vehicle?
people can borrow in their own personal names. People can borrow through propcos, family offices, special purpose vehicles like an SPV, or through some kind of fund structure, private equity. There's various different types of borrowers out there. We don't usually see commercial property being traded in people's own name. I am not a tax expert. I will say that once again for anyone listening. I am not a tax expert. However, there are different tax implications for buying in your own name. Chief among them is income tax, capital gains tax. You're somewhat insulated from these and others when you have got assets in some kind of corporate entity. There is also liability, personal liability, rather than a limited liability that you get through an SPV.
Okay.
So it works both ways, but generally speaking, when buying commercial property, and even nowadays when buying buy-to-lets, most people are incorporating before they transact.
Understood. So it won't be in a personal name.
Yeah.
Sounds like maybe a tax session might be for another podcast.
You're very much welcome to host a tax session. Not only will I not be participating, I might even struggle to stay awake during. But no, I think it is a minefield out there, so I actually think it might be beneficial to your listeners.
That could be, actually. That's food for thought. And so you've done your initial due diligence, you've had the information pack sent over to you, it's something you want to run with, this mixed portfolio. Yep. What's the next step then? You like the borrower, they're sensible in their appraisals. Sensible,
experienced, liquid, capable, referenced. So actually sometimes we'll just pick up the phone saying, word on the street is you've transacted with these guys before, do they know what they're talking about? You know as well as I do that the real estate market is vast in terms of transaction volumes and the money involved, but relatively small in terms of the number of players. It's very much a people industry. So before lending someone some money, you want to make sure that person is reputable. Obviously, we'll do our credit checks and analysis on assets and stuff like that, but actually taking a personal reference about conduct is often really important. So we try to do that wherever possible. So all of a sudden you're comfortable with who the borrower is, you're comfortable with them as a counterparty and their ability to not only execute the strategy, but stand by it if the going gets tough. So then you look at the real estate. I'm talking about the bricks and mortar, talking about the resilience of value, notwithstanding the cash flow. Where is it? What is it? How is the demand for that, generally speaking? If we're talking about, say, an office, is it central? Is it secondary? Is it modernised? Is it plug and play? Is it in need of works? Does it have the facilities? Nowadays, you're really thinking about the EPC and the energy sustainability of the asset. Now, not all of them need to be perfect, but all of them need to be considered. For example, if the EPC is subpar, what is the strategy to get it up to the minimum energy efficiency standards? How is that going to be funded? If the income is relatively short profile, what is the attractiveness of this? Why do you like it? And that might be the reversionary rent. That might be a conversation that's been happening with the existing tenant. It might be the desire to get vacant possession to undertake some kind of value add strategy, whether that be a full refurbishment or a demo and change of use, say a hotel or co-living or whatever. So really understanding the quality of the asset and the strategy. And then you look at the passing rent. So how much income is coming in, and what is that as a function of the day one interest costs?
Okay.
And that's a really important consideration, and the industry refers to that as the ICR.
And what does that stand
interest
for?
cover ratio.
Okay, great.
So
okay.
it's the relationship between net operating income or gross rent, dependent on the portfolio, dependent on the asset class, and the interest costs. Very easy to calculate if they're going to be on a fixed rate, less easy to calculate if the rate is tethered to SONIA or the Bank of England. Then you look at that ratio, have a think about it. If it is in deficit, so sub 1 times, then the income is insufficient to cover the interest costs.
So that would mean a no-go, potentially.
For many lenders, yes, actually. At OakNorth, we pride ourselves in our flexibility.
Yeah.
So if you're buying a grade A, fully spec'd out office, which is only 20% let, then you're really not going to do a reasonable transaction to a strong borrower because the day one income isn't there.
Yeah.
Or do you buy into the asset, the cash flow will follow, and then you use structuring to get you to the point where your interest is covered from the rent. And that might be through an interest reserve. Okay. So effectively advancing the borrower the interest costs for a period of time up front over and above the net loan proceeds.
Yeah.
Or you could take an interest guarantee.
Okay.
Or you could cross-collateralize with another income-bearing asset. So there's a variety of different angles that you can approach to make sure your interest costs are made.
Yeah.
But the most important thing during any underwrite is how are we getting repaid on a monthly or quarterly basis, and how are we getting out?
Yeah.
Because lenders aren't in this business to stay in a loan in perpetuity.
Yeah.
They want to get repaid.
Absolutely.
More importantly, they have to get repaid.
That's a very good point. And I guess I like the fact that there's flexibility there and it's not just a straight no because you're falling below.
It goes into
below
what we were saying, because for entrepreneurs and by entrepreneurs shouldn't just be smiled and forgotten about.
Yeah.
We understand that sometimes if you're sitting on 10 million of cash, it makes sense to buy something with a value add strategy, let's say a let up strategy, because you're not paying a premium for someone else's hard work. In its simple terms, you're going to buy it to do the hard work so that you can make more of a profit when you sell it or refinance it or whatever it is you plan to do. So that's a very entrepreneurial strategy. There needs to be an entrepreneurial bank that can buy into that. And a lot of people will say, yes, that's very well and good, but how do you know they're capable of doing it? Buying something with nil income might be a bit run down. How do you know that they're capable of doing that? And that's where we at OakNorth really differentiate ourselves, is we actually invite our borrowers into credit committee. We sit around a table substantially bigger than the one we're sat at the moment. And
no microphones there.
No microphones, but a similar level of scrutiny. And we chat about the deal. The borrower pitches, this is what I'm going to do, this is how I'm going to do it, and this is why I like it. And then our credit committee, which is comprised of our sort of CEO, head of credit risk, head of debt finance, they will kick the tires and they will say, what do you think about this? And what do you think about that? And what would you do if this happened? And we listen, see how the borrower answers. Do they know what they're talking about? Do they know the asset class? Do they know the market? Not just the macro office market, but the sub-market. Do they know what leasing activity has taken place in the last 3 to 6 months? Do they know who the key agents are?
Yeah.
And if we get comfortable that they know what they're talking about and they've got meaningful skin in the game and they've got the ability to follow their money if required, then all of a sudden, whilst it might be a precarious underwrite to start with, you're confident that it's the right borrower, the right asset with the right strategy. So there is a deal to be done. And then it goes through the negotiation phase, both in terms of pricing, leverage, structure, recourse. A lot of considerations there.
Now, I think that's really interesting because a bit thinking back to your APC process, having the interview and asking those questions, as opposed to just producing a written piece of work, you really test the validity. You understand, don't you? You see probably the whites of their eyes.
Absolutely.
And whether they know, as you said, know the market, know the sub-market, know who's operating.
Absolutely. And two different borrowers could come in with very similar assets and get very different responses because of their track record, because of their strategy, because of their reputation.
Yes.
I must admit, I've worked at a variety of lenders before and I know of many more in the market. I don't think anyone else, any regulated bank does this.
So it's unique having the borrower,
I
having your
believe so,
client
yeah.
come into credit committee.
And I just don't get it. I don't get why more people don't actually have bilateral conversations with their customers or their borrowers rather than do so through some complex structure which is behind the curtain and no one really knows who's making the decision. We own the decisions that we make and we're happy to sit in front of you and explain it. Generally speaking, when speed is important in this industry, which it is, being able to give the customer or the borrower a call within an hour, giving them the update.
Wow.
So I often say by the time you're back at your office,
we'll give you a call.
You'll know the outcome of the committee. Okay. And that's really important because most people need that to exchange contracts. If they know that we're there, they'll pick up the phone to the agent and the lawyer, say we're good to go.
Yeah.
And speed is also incredibly important to us. So we built our reputation on speed and flexibility. You know, £11 billion worth of lending later, I think it's a model that works.
Is that what it's been since 2015 then?
2015,
wow.
Do the maths. It's pretty impressive growth.
Wow, okay.
We've had a couple of absolutely enormous years. Interestingly enough, they were in times of adversity.
Yes.
So 2021 was our biggest year. We did just under 1.9 million. So 1.86, I think it was. And that was during COVID. The reason being...
That was 1.9 billion?
Billion, yeah.
Wow, okay.
The reason that we did so much during COVID was because other lenders got really scared.
Yeah.
They didn't necessarily move quickly enough to devise a strategy. And because we were still quite small back then, 2019, 2020 it was actually, we were able to make really quick decisions. Our ex-core, very hands-on operationally. And we were one of the first movers into CBILS, the Coronavirus Business Interruption Loan Scheme. And we really went from strength to strength that year. And then last year, 2023, with fiscal environment, high interest rates, a lot of volatility in inflation, geopolitical environment, cost of living, you name it, it was all there. That was our second biggest year. We did just under 1.8 billion. We're generally consistent throughout the cycle.
Yes.
And that's actually an attribute that we like to see in our borrowers as well.
If there are headwinds, it sounds like you thrive.
I think so.
Yeah, and I guess that sort of makes sense with what you're saying, the ethos of the bank.
Exactly. Listen, there is debt options out there, and actually the number of options has expanded drastically since we entered the market. Perhaps we were pioneers in that, I don't know. But when you've got a new build, fully let, prime located office to UK government, someone's going to lend you money on that. That's the easy stuff, and that's the stuff that we'd love to do, but aren't going to compete with because of the pricing.
Of course.
Where we differentiate ourselves is more complex strategies, more complex ownership structures, a more thorough underwrite, resulting in a value to our borrowers that they might not necessarily get in the debt market.
So going back to your credit committee, you've had a yes on the mixed portfolio.
Hopefully.
With your client. Your clients arrive back at their desk.
Yeah.
You've called them to tell them the good news. What does that mean then at that stage? So you've had a verbal confirmation, we're ready to proceed, we'd like to loan you some money against these assets.
Yes. So
what's the sort of next step then?
Listen, the high-level terms will have been negotiated.
Right.
Pricing and leverage. Those will have been predetermined. Pricing, term, leverage, some key conditions. But there might be a bit back and forward on the heads of terms.
Okay. So leverage is clearly it's something we come across regularly.
But that's determined at the outset, because if a borrower needs 6 to transact and we only say we're going to do 4 million or whatever,
you're out.
Then we probably won't get much past an initial conversation.
And is that always linked to the market value, your leverage?
Not necessarily.
Okay. Because sometimes you ask us for a vacant possession value, a special assumption. Would you sometimes link it to the vacant possession?
It can be. It depends what the strategy is.
Okay.
Because market value might be far more than what or far less than what they're paying. They might be factoring in some hope value.
Yep.
And you might take some of that into consideration if there is a marriage. Let's say they've got the adjacent property and they think they might be able to combine them and build something across both titles. It might be the case that they're putting in a significant amount of cash to compensate for the hope value. So actually our loan to value might be moderate, but our loan to cost is relatively low. And the loan to cost metric is important because it determines skin in the game, the ability to follow, the liquidity at the start. Certainly for development projects where the special assumption development value is a special assumption. It's hypothetical.
It's not been realised yet, has it?
In terms of sizing the loan, I generally use cost as a better barometer. 65, 70% of the levered costs. What does that look like? Usually 55 to 60% of value. It's generally a delta of about 10% in between those metrics, but that's where we like to be. If they look for more, then there's obviously the ability to widen your capital stack in terms of mezzanine finance or any other type of stretch senior.
It sounds like another podcast, doesn't it?
Oh,
the different types of finance available out there. And so you've had a yes. Terms have been agreed then. I hadn't appreciated that.
Yes,
that would have been done, so apologies.
So the high-level terms will have been agreed, and then they'll be negotiating the term sheet, which is effectively...
Yes. It's like your heads of terms.
Correct. It could be a 10, 12-page document, and it forms the basis of the loan agreement.
Understood.
So at the point of which that is agreed, we then splinter off into a couple of key work streams.
Yeah.
The first is the legal work, which will include the property due diligence, the security work, and actually drafting the loan agreement, the finance work.
Mm-hmm.
Then there will be the valuation work, which I don't need to tell you about. And then in some instances where there's a development project, you might even look to instruct a monitoring surveyor.
Yeah.
Project monitoring surveyor. The valuation work is pick up the phone to someone who you think might know the asset.
Yeah.
And who is a reliable valuer. If you've got any recommendations, let me know.
Let me have a think.
What that does is it ratifies our own internal analysis and gives us comfort that we're thinking right and the borrower's thinking right about the project.
But that I hadn't quite appreciated. That's just one key element, but a small element. There are other processes there, like you said, the monitoring element. There are a few things you're running there.
Exactly.
Because when we're dealing with you and helping give our advice, the valuer isn't necessarily appreciating that you're probably dealing with another 5-6 agencies.
Another difference, a few,
few other key parties that are providing you with the key intel.
Reports, analysis,
that you
documents with reliance, whatever it might be.
Yeah.
Whether it's because I qualified as a surveyor or not, I generally find the valuation work stream is the path of least resistance. Dealing with lawyers is a different question. With the negotiation on terms, conditions, various other elements. Every single property report you read has got an issue with it. Fighting fires with that. And then all of it culminates a couple of weeks later in terms of you got comfortable with everything. The loan agreement is in an agreed format. Securities ready to be taken and all been negotiated. The valuation has come in lines with expectations, and the monitoring surveyor has issued an initial report which hasn't flagged any concerns. Yeah. For a development project, you get all that in, and then theoretically you can deploy capital.
And then monitor that over the
course of the loan. And that is of vital importance, by the way, because anyone can lend money.
Yeah.
It's the ability to get it back which differentiates those that are successful to those that are not.
Yeah. As you said a moment ago, it's all well and good getting it out there, but you need to be repaid.
Have to be repaid. Yeah. And the best way to do that is to closely monitor. And I'm not talking about Big Brother watching here, but not far off. I'm talking about maintaining that partnership. You spend a lot of time cultivating relationships before an asset lands in your lap. And then during the negotiation phase, you're actually working together to find a mutually agreeable outcome. That partnership doesn't stop once money goes out the door. That partnership maintains throughout the duration of the loan. The communication has to be excellent and consistent. And then even past the point where we get repaid, you maintain those lines of communication because this is a relationship industry. And if you transact effectively and generate goodwill and everyone's happy with the conduct of the other parties, there will be more deals to follow. There's a lot of conduct, a lot of focus on relationships, and the fact that a lending relationship shouldn't be transactional. It is a proper partnership. And I think that's how we've differentiated ourselves in the market.
With what's gone on over the past 18 months with, as you said earlier, the fiscal challenges, interest rates rising, ICR has obviously probably become a big issue.
Yep.
What do you do then? How do you manage that whereby you're dealing with a great client, a great asset, but the ICR is in breach? I don't know if that's the right term. And you couple that with take the office market, for example. A lot of money maybe needs to be spent on the building. Yields are pushed out as a result of the cost of money, and your LTV is in breach as well. So you've got two things there that are creating a problem. How would you deal with that?
I've actually already given you the answers. The first answer is consistent monitoring.
Yeah. So you've already got to the...
You can see the road bump down the road. And you know that's coming. So you take preventative measures. What does that mean? That means you could potentially reduce your interest cover ratio. Mm-hmm. So you might have started off at 1.5 times interest cover ratio, which is actually pretty market standard.
Yeah.
And all of a sudden the interest costs are rising and the rent's staying the same. So that's going to breach. Reduce it to 1.3, theoretically. If you think that the borrower is capable of delivering consistently at that ratio, you know that there's still headroom between the income and the interest costs. The path of least resistance is to give them that breathing space. We're not in the business of enforcement here. We want to work with our borrowers to undertake their business plan, because an asset in distress doesn't benefit anyone. So the monitoring in advance is important. And then the second clue I gave you before was the importance of the relationship. So when you do see a road bump, you pick up the phone, you invite them in. Let's have a chat about this. What is the situation? Talk to me about the resilience of your income. Get me comfortable in that. If you know that you're comfortable in the income and it's only an issue, a relatively short term, maybe 2 or 3 year issue with your interest cover, let's try and solve for it. Ideally, the borrower will say, do you know what? I'm going to put my hand in my pocket and I'm going to top up or pre-fund an interest reserve or cash pay interest cost. As a lender, we always know that this is going to be a risk, so we often account for that through maybe an interest guarantee or a personal guarantee, so that we know that in such a downside situation that the borrower is going to be there to step in, and we'll have done our due diligence on that.
You've got a fallback, haven't you, then? You've got that extra provision. Yeah.
But sometimes there are guarantors who have lost liquidity. So if the interest cover on this asset is tight, suffice to say the interest cover in their wider portfolio might be tight because it's a macroeconomic variable.
Yeah.
And that's a whole different ballgame. And I am not qualified to talk about that. My colleagues in our restructuring team are absolutely excellent and very collaborative with our borrowers, and generally speaking, we engage them early on, find the right solution, move them into workouts to be worked out and back into portfolio management. That's the plan. Nearly always works that way as well.
It feels this time round, where we've got these challenges in the market, it feels quite different. My experience of it has been different compared to when I first started work as a surveyor, as a valuer. The market was stressed in different ways and there was a lot more distress. There were a lot more lenders out there appointing receivers to deal with. And there wasn't that, as you described it, there wasn't that good ongoing relationship. And it feels to me now, certainly people like yourself and other lenders we talk to, they're dealing with it and hand-holding and helping, and maybe because of what we learned last time round.
I think you're right. And I think there were a couple of input factors that were different in the GFC. The first of which is it was a far higher levered environment. So I'm going to ask you, Andrew, what would you say is the average loan to value on a transaction?
I would say average, somewhere between sort of 50, 55%, I would say.
And what do you think that number was in 2006, 2007?
Well, in excess of 75,
I think you're right.
Big difference,
I've
isn't
heard
it?
anecdotes of transactions at actually 100% of cost. They're fully funding the acquisition. And I only started my career post-2008, so I can't even fathom that as a concept. The market was what the market was. And in a boom environment, of course, if you're buying at 10 knowing that it's going to go to 12, why wouldn't you lend higher? So the first starting point is that the leverage position has been lower before 2023. For the last 10 years, it's really been, you're right, 50 to 55% is probably the average, which means that there is the ability to support your borrowers by potentially deploying a bit more. We might do another million, say, to make sure that we can weather this storm. That's the first thing. The second thing is no one benefits from an insolvency. or handing it over to the receivers. That really is the last option once all other strategies have been deployed. So you want to work with a partnership. You want to partner up with your borrowers. You want to partner up with their advisors, their equity sources, whatever it might be. And you are right. Lenders are offering more forbearance than they ever have.
It seems to be.
And I think that is because they remember what happened in 2007, 2008. I also think it's because they are potentially better capitalised now. They're more resilient, so there's less panic.
Okay. When you say better capitalised, there's more liquidity there as a bank.
Well, the banks are required by the regulator to hold more cash than they did back then.
And will that differ? Forgive my ignorance. Will that differ between a certain type of asset? So
yes, you're absolutely right.
You'll hold more cash for, say, commercial.
So this goes into risk weighting, and the regulators set the risk weight, as in how much cash you need to hold for every pound that you deploy.
Okay.
And that varies between assets. For example, on buy-to-let residential mortgage, you might have a portfolio landlord with a dozen buy-to-lets. We hold far less capital aside for that than we do for a development of a block of flats.
Yeah.
And the reason is it's the risk that's associated with it.
And the regulators set how much?
Yeah. And as a result, it's cheaper to borrow on a buy-to-let or a resi portfolio than it is to do development finance.
And is that why then, so if I come to you with a multi-let office, the risk weighting is higher, the capital allocation is higher
than it would be in a sort of resi portfolio.
A resi portfolio. And that's why then the rate you charge is more expensive.
That's one of the considerations.
One of the reasons. Okay.
The other considerations are your OPEX as a lender. How much does it cost you to run the business? Your operational expenditure.
Yeah.
And where the risk is. So you might have as I said, you might have this portfolio which is being bought by Joe Blogg's property trader or a global fund, and the rate being offered might differ because of the quality of the sponsor.
Of course.
So everything, whether it's leverage, quality of the sponsor, income, asset location, whatever, they're all kind of interact with each other to generate one set of terms.
And what about loan term? The length of time you're going to lend the money out for? Does that have an impact too?
Absolutely.
Okay.
It has an impact in terms of your returns, but it also has an impact in terms of their strategy. So if a borrower's got a 3-year strategy, you want to lend for a longer period than that.
So you want to lend for 5, typically?
4, 3, whatever it might be.
Yeah.
At OakNorth, we've got the flexibility to lend really, if you wanted a 3.5-year loan, we can factor that in if there's a justification for that. If you wanted a 3+1, i.e. with the option to extend for an additional year, which would be with mutual consent, then that's a structuring question. But depending on what the strategy is, you can devise whatever loan term. Generally speaking, sub 6 to 12 months, the bridging market generally have covered because far less paperwork in. You're paying a flat rate per month than what you've deployed. They are often not subject to the same regulatory framework as regulated banks are, and therefore you can transact very quickly in and out. That sort of 12 months to 5 years where the senior banks generally play. Any term within that, and then actually the insurance money, pension money, they can, all they want is CPI annuity income.
Yeah.
So income that will pay them off and generate some yield for their portfolios. And ideally, they can do 10, 20-year money.
I mean, that's more unusual, isn't it? I guess
we don't see those type of transactions.
We don't see a lot of that either, and it tends to be on the much bigger ticket. And at the end of your loan term, at that point you might then enter into a negotiation again about refinancing. Your client may wish then, having achieved their strategy, to take the debt elsewhere. There could be a whole myriad of things. And is there a hard stop at say it's a 5-year term at expiry if they've not been, because of macroeconomic factors, they've not been able to move their debt to another lender or the other extenuating circumstances?
So we generally insulate for that. In advance. So if we don't want to extend a facility, it's probably because something hasn't gone according to plan. We would have communicated that in advance and given them the option to, or perhaps encourage them to go and find someone. That doesn't happen that often, but it can happen. Generally speaking, as the end of the term approaches, we would look to try and stay in. Our niche in this market is banking the deals that are a little bit harder, more complex, where there's more work involved to undertake the strategy. During the term of the loan, the hope is nearly always that that strategy is fully executed. And therefore, at the end of the term, you've got a far more bankable asset. So whilst we would be happy to stay in, often is the case where they would say, do you know what? Thank you so much for allowing us to buy this vacant land, build a block of flats or build an office and stabilise the income. But actually, now that we've got a 9.5-year WALT with 3 anchor tenants, strong credit risk, we're going to go and refinance that at 1.5 over.
Yeah.
And we don't compete with that. We'll say that's absolutely fine and best of luck to you, on to the next.
Yeah.
And that's the ideal.
Yeah.
The beauty of what we can do is the entire life cycle of a loan. So from acquisition of a vacant asset, all the way through the planning stages, through to the demo and rebuild or the refurbishment, and then the stabilisation, and then the income period. We can provide a sort of 5-year facility to cover that entire life cycle, which actually not that many lenders can. What it does is it gives the developer or the investor the ability to do what they do best, rather than thinking about, I need to refinance this, I need to take it off bridge, put it on CapEx, and I need to take it off a development loan and turn it into an investment loan. And then, the loan is expiring and I don't know what to do. What we'll do is fully bake it up from the start. There will be hurdles and the pricing will ratchet in line with the risk, but effectively provide one facility throughout the life cycle of the strategy. And our borrowers find that incredibly useful, because if you're a property developer, you don't want to be spending time on the phone to the bank. You want to be on site, or you want to be finding your next project.
And there's a lot of cost involved with moving and restructuring from one lender to the next. I know that, and I've heard stories of how expensive it is to do that. It sounds like you have to have a lot of patience in what you do. We were chatting earlier about a couple of loans you've done, one of which you started, I think, when we were staring down the barrel at sort of several lockdowns, the end of 2020. Yeah. What was that? You tell our listeners.
Yeah, it was, listeners will fall off their seats. It was an inland surf park.
Yeah.
And it was a really unique asset. And as I said, late 2020 was not a time to be going out for debt. As it so happened, because this was within 6 months of the pandemic starting, I personally was working from home and had evenings and weekends and all the other time in the world to think about work.
Yeah.
So I kind of entertained this strategy and got under the bonnet, looked at the market, looked at the capital stack and the sources of capital, and I thought there was a deal there. This was November 2020. We finally signed the loan agreement in November 2023. It was roughly 3 years until we started deploying. Yeah. And it will be built by September.
Fantastic.
So it's a 4-year life cycle. The takeaways of that were unbelievable in terms of harnessing a fantastic relationship with these guys. We were there through thick and thin over the course of 3 years of negotiating.
Wow. Had they done similar projects?
Never.
So this is a first for them.
Yeah.
A unique asset.
Unique asset. First of its kind in Scotland, third of its kind in the UK, with the previous two trading far less than what the projections were for this. We got comfortable based on the strength of the market and the capital stack, so the quality of who our counterparties were. There was Scottish Government money involved, and then at the end, once we'd actually negotiated a portion of the debt, we knew that there was going to be a ground rent transaction to fully repay our debt. So actually, underwrite was validated.
Once built out, will you be going to try it out?
I'll get my wetsuit on. No, I will.
I think there'll be...
Do you know what? Not because I want to try surfing, but because I've got such a great relationship with this borrower now. Yeah. Just to catch up.
That's
find
fantastic.
Out what's next.
I look forward to seeing the LinkedIn post on that, Greg. Hopefully a video.
Hopefully not video.
No, just a few photos. It's been really enlightening to hear about all the intricacies of what you do. But understanding what goes on behind the scenes is fascinating. So thanks for taking the time to educate our listeners. It's been great to hear your stories, your experiences at OakNorth, and look forward to doing more together.
Good.
Thanks,
Thank you for having me, Andrew.
Pleasure. Thank you.